Marketplaces have been revolutionized by digital. In capital markets, I don't really think that's begun fully yet. They've been electronic, but not fully digital. If you look at traditional financial markets, although the trading is very electronic and fast, what happens post-trade is a bit of a nightmare. It's quite manual. It's lots of intermediaries involved, lots of reconciliations.
Where the real power of this comes is in middle and back office efficiencies, the elimination of reconciliations, making things work better.
A blockchain purist would say, yeah, but with tokens and everything and blockchains, we don't need all this regulation. We don't need all these counterparties. We don't need a lot of the infrastructure that is there today.
The cost of intraday liquidity buffers is absurdly high. You could not sack enough people in India or outsource anything to make up for those costs. The better job we do in the long run of taking the securities asset and the payments asset apart and making the payment asset available to as many processes as possible, the better that will be for everybody. If the assets and the payment are too tightly coupled, we end up with a bunch of Euroclears. And that's the model we've had for ages. It fragments liquidity. It is frighteningly expensive, all that liquidity.
The dematerialization of the public securities market is nearing completion, but the majority of the $6.5 trillion private securities market remains opaque, inefficient, illiquid. Actually, the efficiency plays that we are talking about here, the new revenue streams that people are interested in, is in that private securities space. And what we're looking to try and bring is those public security market benefits to the private securities market. So we won't start with the public securities. We've already been through that evolution. We've spent a phenomenal amount of money making price discovery in the public securities market efficient, but the private securities market is where the next wave of revenue and the next wave of efficiency. The majority of private securities today are either sitting in someone's inbox as a PDF certificate, and you've got to service that over its life cycle, try and secondary trade that, good luck, or it's sitting inside an electronic database inside the issuing platform.
Security tokens are offered primarily on private securities, and you've witnessed over the last few years an exponential growth in private securities, be it on real estate, equity, private debt. Beyond the security token itself, it's accompanying the growth of private markets as a whole.
Switzerland's seen, and they are a market leader in this, seen an explosion of issuers. So the actual cost of doing an issuance is now an order of magnitude cheaper, and therefore a huge number of new entrants have come into the market.
We can see who has the inventory and we can see who has the money, and it's effectively a book entry swap. On the custody side, we can see who owns the tokens on the deal side, and we can see who has money in their account on the fiat side, and the settlement is instantaneous on our exchange. So we don't need clearing houses involved. It's all sort of taking place within the Archax ecosystem. In time, that will change, and people will trade on markets on margin and in other ways, and you don't necessarily want a fully funded model.
We're also involved in project for a commercial bank digital currency. So that will facilitate the delivery versus payment on chain.
I don't think everything goes to T0. That said, I think the market has massively underestimated the benefit of shortening the settlement cycle, massively. And we found out that across 15 large institutions, the counterpart credit risk, if you moved it by 1%, 1% would save you $300 million each on average in risk-weighted assets.
Liquidity is the biggest barrier to adoption.
When it comes to liquidity, it's really about how many buyers, how many sellers, total value of the assets, and the bid-offer spread. So it's a state of the market, and that will depend fundamentally on the type of assets that we're looking at. The issuance and the number of investors is still limited at this stage. So we don't foresee market makers appearing to provide extra liquidity than what is happening right now.
In the DeFi space, the lending and borrowing is has to be over collateralized, right? Because it's an anonymized system. Unlikely that will work for I think for security tokens. There are quite a few interesting projects right now in the DeFi space that are basically trying to bake identity into the protocol and basically create a more institutionalized version where you can actually allocate credit.
If you have a fragmented set of blockchains, you're going to fragment the liquidity. Interoperability becomes challenging because our model of an encrypted distributed ledger with what we call secure channels to decrypt to plain text state machines implies the way we execute transactions. And I think you can standardize on the data, what's the definition of an asset, but I think it's hard to standardize on the smart contract layer because it is so tied up in the transaction layer.
There are different protocols, there are different type of smart contracts, and interoperability is an objective.
Liquidity aggregating along a certain set of protocols makes a heck of a lot more sense than fragmented protocols.
There are other standards out there, and then it's going to be competing standards. There could be breaches, but the technical challenges are high. And so we will see from the adoption which are the winning standards. There will be competing standards, and we'll see what will be the most used and resilient blockchain for tokenized securities.
We've had a number of standards in this space that over time have become the go-to. Certainly the world doesn't need 100 blockchains, but what we are seeing is a consolidation down to the point where we can actually get to a set of standards, and at that point the technology can conform to it or not.
At the end of the day, we will see sort of consolidation into one or maybe a handful of blockchains, and we will see a consolidation into one or handful of probably formats.
The Fin P2P initiative, what they're doing is primarily at the moment around in the private securities world, but allowing you to issue a token on one blockchain and settle it on another. So they're trying to insulate sort of the financial markets business world from the underlying technology, which I think is the way forward. We don't worry about TCP/IP when we use a browser. We don't care what underlying protocols we use when we send a mail message. We just use the technology without thinking about it. And I think that's the direction of travel that we'll get to. The success of blockchain and digitization and tokenization will be when we don't talk about it anymore. It's just the underlying technology that everyone's using because it's the most efficient. We talk to all the big investment banks all the time about digitization. I know for a fact that all of them have blockchain DLT teams looking at this space because they can see potential benefits from it.
Where do those assets come from? There are a lot of assets on banks' balance sheets that they're going to have to go and get rid of at some point because the new Basel regulations are going to force them to do something. The banks will not be able to do the same things with their balance sheets they've done before. They need to stop assets getting on there in the first place. It could drive tokenization.
That education is mostly just to wrap their head around some very basic things around the DeFi space, right? Just to explain people how Compound, which is, I think, sort of the most well-known and well-used protocol on DeFi, just to explain people how that works and how come you have interest rates that fluctuate every 15 seconds. That as itself is sort of like mind-blowing for them.
The reason you're seeing different technologies coming into this space that do have privacy and do conform to AML CTF regs is because they know full well that those regs are not going away.
The regulation is not so much about creating pressure to adopt, it's about ensuring that it's not an obstacle to adoption. You can still have data on a ledger that is widely distributed if you encrypt it properly, such that you only allow access to certain players. So I don't think you need a CSD to do that. We've chosen to execute it with a data model that ensures that consensus is achieved effectively on encrypted data. So the data that is distributed to all nodes is fully encrypted. It's purely cryptographically based privacy solution, not a peer-to-peer trading. Do you therefore need some kind of a CSD in the process to maintain that secretly? And the answer to that, I think, is no.
Regulations mandate that we do have to use a CSD. The CSD in a regulated world could be a facilitator of managing that, controlling that, and providing interoperability between different blockchains, for example. So the advent of a blockchain-based CSD that is blockchain agnostic as well as being blockchain built is really quite interesting in allowing digital securities and security tokens to realize their full potential.
I don't think you need new regulation. I think if you execute correctly, you can live very much within the regulatory framework that in many ways predated the creation of the CSDs.
We've seen actually projects that basically bring zero knowledge proofs and layers that actually allow you to do full anonymity on public blockchains. There is a pretty serious group of cryptographers that build a zero knowledge proof layer for Ethereum that is currently in production. Of course, it's easier to solve this problem in a private blockchain. Integration of closed systems is much more difficult than basically integration of some of those open systems.
There is a benefit to netting. And so if you're instantly settling everything atomically, you might end up with more capital. However, in especially the case of variation margin, if you're reducing the amount of time that you're out, you're reducing the level of volatility and amount of capital. I think that we can achieve the risk mitigation in a peer-to-peer way without introducing the risk that you get with a CCP. CCPs do not fail very often, but when they do fail, it's a really, really big deal. It is a massive point of centralization.
The CPMI, who opine on all of these things, have been pretty clear, particularly around Bitcoin and stable coins, and more generally around digital assets, which is same business, same risks, same regulation.
If you kind of create a regulated DeFi environment where you're sort of taking the benefits of what's been pioneered in the DeFi space, but operate them in a regulated way, is a really interesting evolution, I think, of what's happening. What's been pioneered in DeFi.
NFT was a dormant space for quite a few years. When you think about a real estate token, one way to look at it is, it's a type of NFT, right? Once we basically started to see that part of the market picking up, we actually started to see also DeFi projects that are basically directly addressing that part of the market, right? Once we will actually be able to get security tokens into some level of mainstream, I think that they will actually follow the path of DeFi much faster than we think.
I think the benefits here come on the balance sheet side, counterpart and credit risk. Intraday liquidity buffers. Those are the really big numbers, and then getting that stuff off the balance sheet that they don't want there. The benefits are less in the transaction processing cost. All the benefit comes on the balance sheet side. By the way, reconciliation is not going away. We will have books and records with ledgers versus statements for a long time. The reconciliations might get easier.
It is also about the transaction cost.
Many of these costs that we talk about in transactions are really quite low. It's just not very expensive to be a custodian. It's a low cost system. I've spent a lot of time really wondering about gas prices and things like that. A blockchain, especially proof of work blockchain, even proof of stake, has inefficiency built in on a tech side. And I mean, it's got to be expensive to solve a proof of work equation. That's what delivers the integrity. And so balancing that against the elimination of intermediaries, I think is going to be a real challenge.
The cost of transactions on blockchain, there are two elements here, the absolute price and also the variability of the price. It's hindering adoption, it's true, but you can have solutions through proxies or side chains that reduce drastically this issue of cost.
On the gas price side of things, I mean, it depends what blockchain you use.
We talk about gas being a problem, and yes, it is. You want to be very careful about which platform, be it one that is charging you gas or one that's charging you fees, that you end up on, because if you give them the keys to your kingdom, they're going to have pricing power over you.
Debt issuance and structured product issuance as well. There can be some substantial savings.
Some of the costing that we've seen is a 40% takeout on average of the cost of issuance, post-trade settlement, and asset servicing.
It's not actually will be about saving. Maybe there will be saving, but I think it will be actually around things that we will be able to do that we cannot do at the moment. I'm not sure that everything is in this space is really around saving. I think it's really around the fact that you essentially re-platforming into an infrastructure that over time will allow you to do things that you then create products that you cannot create with traditional assets because of how the ecosystem is structured.